Hello, income harvesters and income investors. Welcome back to the Harvesting Income channel. Today, I'm going to talk about this unique fund known as DIVO or DIVO, and this is the Amplify CWP Enhanced Dividend Income ETF. The reason I'm going to talk about this is a little different from the traditional or the conventional covered call funds. Uh, and specifically, I like this fund because this fund has something that is different from the others. And can this fund really solve the nagging problem that we have with NAV erosion? So that's the question I'm going to answer. But first, let's understand the fund, the metrics, the strategy, and so on. And if you stay with me till the end, then you can also, understand how the fund works, and then hopefully by the end of this video, you will find the answer to this question. Okay, before we go ahead, quick disclaimer: all the content and information that we discuss is for knowledge purposes and not financial advice. Please do your own due diligence or get professional advice from your investment advisors or financial advisors. Okay, with that, let's move into the funds details. DIVO or the Amplify CWP Enhanced Dividend Income ETF. This is basically a two-pronged strategy, and they select high-quality large cap stocks. The difference is this fund doesn't follow the specific index like S&P or Nasdaq or even Russell 2000. They pick specific large cap stocks. Some of those will be in the large indices, but they specifically, pick stocks based on certain characteristics, fundamentally, like which have good positive cash flows, and dividend stability, and so on. That's number one. Number two, they write calls for additional income on select stocks. Very selective about that. So they do it in a very tactical manner. So sometimes they may not write calls on certain stocks if they feel that just holding those stocks can be more attractive just by getting the capital appreciation and dividend. So in that case, they may not simply write the call option just because they want to generate that income. So here they're trying to be little different, not a cookie cutter, covered call fund. Okay, let me give you the basic metrics and then we'll go one by one into the various aspects of the strategy. Ticker symbol is DIVO, as we have seen it, and price is around $46 as of April 17th. The fund is about 10 years old, like February 2016 is the inception. So it has a long track record, it's been in the market for a long time. Net assets about 6.9 billion approximately. Very large fund, I mean, for this category. And expense ratio is about 0.56%. And expense ratio, I would say, is pretty attractive because I have studied the strategy and what they do. So given the fact that they do a more nuanced and more dynamic strategy, which involves a lot of judgment and a lot of research and so on, I think this is attractive. But generally speaking, you can say the fee is reasonable. Okay, how does this fund operate differently from the others? What makes this so different? Basically, it's the active management of the fund at different levels. Like one is the stock selection part of it, and then they how they manage the portfolio and how they write the calls. Okay, the first part is the dividend growers. Like if you just look at the diagram given here, this is from the Amplify ETF website, fund website. You can get all this information there. I'll just give you a quick summary of everything. So basically, they pick dividend growers, like companies which have you know historically high dividend and earnings growth, and specifically large cap companies, high quality companies. So not penny stocks or small bets. So that's the starting point. And within that, they allocate funds towards different sectors. Like there are about 10 sectors in the S&P, and the fund manager will decide which sector to allocate more to or less to. And they can also move in and out of sectors. So that way, there's a possibility for, a bit of portfolio rebalancing, the profit taking. A lot of funds do rebalancing, but, some funds don't do that. Some funds are very passive. The fund is more active in that sense. And with respect to security selection, they look at only 20 to 25 stocks. So bear in mind that this can be a little concentrated for some people. If you are someone who is looking at index funds, then this may not be a good choice, because if you're looking for something like an index fund which has 500 stocks or 100 stocks, for example, so that's more diversified, but this is more concentrated, but still fairly diversified across sectors. So for someone who is totally conservative, probably this might sound little bit concentrated, but you can, do your own research on this. For me, I personally, I think this is a good pick. If I had the option, I would buy this at current levels. And by the way, it's not a recommendation. And these are stocks which are screened and adjusted according to different attributes. So it's not going to be a static selection of stocks. Like, it's not going to be the same 500 stocks as in the S&P or any index. It's going to be, changing according to the performance. So depending on that, they would, move the portfolio around. The last part is the tactical covered call rating. That's the part which I want to emphasize, the tactical covered call. So covered call funds write in different ways. Some of them write calls on the entire portfolio. This fund typically writes about 20 to 30% of the portfolio. There are some funds which do like 50% of the portfolio, like, which means the other 50% is acting just like a index fund, like it is growing along with the index. So basically 50% growth and 50% for call writing. But in this case, they are doing 20 to 20%, 30% call writing, which means the remaining 70 to 80% can grow organically. The underlying stocks or the assets can produce those capital appreciation plus the dividends. So just imagine, like, if the market is doing well and S&P is giving you like 20% returns every year for, let's say, a couple of years. In that case, this fund will still do well because it has that exposure to the S&P. Only that 20 to 30% is basically capped in terms of the returns. So the covered call cap will be applied to the 20% or 30% of the portfolio. The other good news here is they're writing call options which are 5 to 6% out of money. So not only are they selective in terms of size of the portfolio used for covered call writing, coverage is already 20-30%, but they also write calls which are 5 to 6% above the current market price, which means like those calls will get assigned only if the stock moves up by 5 to 6%. Let's say there's a 1 month call and the stock moves up by 5%. I mean, it doesn't happen often, but sometimes the stock moves up by 5%. In that case, you get that 5% capital appreciation plus the option is written at that point. You get the premium for that. So you get gains on two different ways. Like, one is your premium plus also the capital appreciation. And thirdly, you also have the dividends coming in from the underlying stocks. So that's why I want to highlight these points here, the last 3 points. The fund actually gives you three income streams. Just like you invest in any dividend stocks, you have dividend income and capital appreciation. Plus, you also have the option income on top of all this, which is like a icing on the cake. And the good thing is you have the highest quality stocks selected. So you don't have to worry about what will happen to the portfolio when the market tanks. And about 5 to 6% out of money calls and 20 to 30% of the portfolio. So that's the tactical part of the call writing, which I already explained. So these features make it so unique and so different that the fund has actually performed so well, and it has been going up over the past uh, 10 years. And it has been, even if you look at the price graph, it's going up like that, because basically what is happening is like the you don't see that nav erosion that you see in other funds. Yes, you see the ups and downs, volatility. Yes, sometimes the fund falls too, but it quickly recovers because there is the element of, capital appreciation. There is an element of dividends, and there's a very small element of option writing. So the fund is not completely dependent on the option strategy. Okay. Yeah, I already explained all that. The three income streams: dividend, capital, and the option income. And if you look at the funds, documents, they say that the fund's gross income is approximately like 2 to 3% from dividend income and 2 to 4% from option premiums. So basically, the fund gets income from, 2 to 3% from dividends, 2 to 4% option premium. Like, that's the kind of yield they get from dividends and option writing. And of course, I already explained that given this kind of strategy, they have minimal upside cap. So since the calls are return 5 to 6% out of money, and also they write calls on only a small portion of the portfolio, there is huge amount of room for capital appreciation. So you don't have to pray that the markets are flat or going up slow, because most of the covered call investors benefit only in flat or slowly upward moving markets. But even in good markets where things are moving fast, this fund is going to perform well. Okay. Now I looked at the past data, and this is actually subject to um, change. Like you can do your own research on this. So whenever you are seeing this, you may see a slightly different numbers. But I looked at the 1 year data for price returns. It's about 21% roughly, 21.3 over the past 1 year. We are talking about around April 20th. That's when this is being done. This is being measured. So on this point, at this point of time, like you have like 21% in terms of the price appreciation of the fund. Then comes the dividend yield of the fund. So dividend yield, I did the T12 distribution. Like I looked at the 12 months distribution, and what I see is like it's about $2.91. And given the current price, $46.26, it's about 6.3%. So this yield is lower than other covered call funds. Most of the funds are like giving you a giving you like 15%, 20%, or even higher. Minimum that you get is like 12% or 11, 12% is like a normal thing for most covered call funds. Usually in double digits, but this one is in single digits. I was actually surprised when I did the research initially. Why would someone invest in some a covered call fund which is giving 6.3%? Then after looking closer into it, then I realized that yeah, there is a reason for that. The total returns are much higher. So the low yield is justified because you have lower income from the covered calls. You have more income in terms of appreciation, and also the dividend income that comes from the stocks, underlying stocks. So, so this fund is actually low on the dividend yield point of view. So some people who are looking for just for the yield could be disappointed. Now let's look at the holistic picture, like total returns. The price returns are higher in this case because see, you look at the price return is 21%, and you have distribution yield which is 6.3. So adding up both, you get like 27.6%. 27% is really good for a year. Now every year you're not going to get this performance. This will completely change next year. It could even be much lower in the future years. However, the point to notice, why is it higher? Like higher is because of the capital appreciation of the underlying assets and the underlying stock providing dividends. That's the reason number one. Number two, the distribution, which is the option premiums, it's just adding an extra icing on the cake. So you have most of the income coming from the price return, which is a combination of capital appreciation plus the underlying stocks dividends plus the distribution from your option premium. Totally, comes to about 27, which is pretty attractive. This is a recent number, but in the past it could have been more or less. So to just give you a more broader idea, I have put up this chart. Like I have zoomed it on the other side to give you the comparison. Like you can see different funds: DIVO, S&P 500, GPIX, JP, and SPY. S&P is the index. The other four are the funds. So when you look at the performance, you can see that DIVO is slightly lower compared to some of the funds. GPIX has done really well, and SPY has done well. So if you look at this 1 year performance, GPIX and SPY are pretty close to the index. DIVO has underperformed, and JP has also underperformed. Like it's not that great. So the winners are basically the GPIX and SPY. DIVO is pretty close. It's not that bad. You can see the DIVO's graph here, orange color. but you can see that it has been holding up pretty well in the, uh, over the period of time. Like, okay, let's look at the 3-year returns. Yeah, so in this too, you can see that, GPix has done well, 67%, and you can see SpyEye has done pretty well too. And DIVO is actually trailing behind SpyEye. So this is the thing that I want to stress here. Like, you may not find the perfect fund. Like, you may have find some funds are, performing better than DIVO, or you might find some funds not doing that well. If you look at the JP, for example, JP is also a great fund. Nothing wrong with it. But in this period, like last 3 years, if you look at it, like they gave only 33% returns, whereas S&P did 72% and DIVO did about 50%. So this is just a comparison to show you a fair comparison or analysis. So this is to say that, um, DIVO is not perfect at all, and even I would say in this video that, DIVO is a great fund, but it cannot beat every fund you have in the market, because a particular strategy works in a certain market may not work in the other type of market. Like, some strategies work well in the bad markets, some strategies work well in bull markets, some strategies work in a slightly upward moving market or slightly downward moving market. Some of the strategies are purely just for the flattish markets with not much of movement, or range bound markets. So it's all subjective, like, and every fund has its pros and cons. Like I always say, that's exactly where we are coming to. So here I would like to give a balanced opinion so that you can do further research, not to take this as a at face value, but take it as a point of reference, and then you can do your own research and then take a final call. What are the pros of the fund? First is diversified objectives, diversified sources of income, capital appreciation, dividend growth, and option income. So that gives you the total return, which is very attractive. That's number one. Practical call writing, like writing out of the money calls and writing only 20 to 30% of the portfolio. Just 20 to 30% coverage means you have minimal upside cap. So upside can be, fully capitalized. Thirdly, high quality stock selection. They don't just pick the S&P 500 stock, they pick specific stocks, not just copying the index. And the fund managers and research team takes a time to pick stocks which have those characteristics of steady earnings, steady cash flows, and steady dividend growth, and so on. And the portfolio is pretty balanced among different sectors, different industries, and they also enter and exit industries to take advantage of the changes in the economy, changes in the market, and so on. So that rounds up the pros side of the equation. Now, coming to the other side of the equation, you have uh, lower distribution compared to conventional covered call funds. Like I mentioned, lower yield because of that, and not many call options are written. Like, the fund doesn't write calls on every stock and every you know everything in the portfolio. It doesn't do a index call writing. So they are writing calls on specific stocks, specific times. So which is a very tedious amount of work. Like, if you have done call writing yourself, you will know that. Like, I've experienced that. Like, if you have like if I had to do call writing on 3 or 4 different stocks, that itself is too complicated. Like, for every stock, I need to look at different strike prices, different points of time, different premiums, compare the returns, and then do a call writing. And whether to write or not is another decision. That's another part of it, which is very confusing. And whether to write 1 month a call or 2 month call or a weekly call, and what kind of premium I'm comfortable with. Do I go for an at the money call or out of the money call, or do an in the money call? Like, it's very complicated. So they are doing very selectively. That's great news. And that also helps the portfolio to be more, stable over a period of time. The focus is more on the investing part of it, and call trading is just the ice on the top of the cake. And lastly, they don't follow a traditional index. That could be a drawback for some people. So that's why I put it in the con. But I put a mitigant here. Like, they have high quality stock selection. So that mitigates this kind of risk. So the third point is not a big con or risk, but just wanted to put it like some people may not be comfortable with non-index funds. So those are the plus and minus of DIVO. So this might have given you the idea why this fund is able to curtail the NAV erosion. Basically because they have this three-pronged strategy. They are not dependent wholly on the option income. So that's why they are able to curtail the NAV erosion, and they do a very limited amount of call writing. So the upside participation is much higher compared to other funds. Now, I'm giving you some alternate peers to look at. Like in the previous charts, we looked at performance. We found that GPIX, Goldman Sachs S&P 500 Premium Income, they came up actually top in the 1 year or 3 year basis. So that's one thing you can consider. Like they do they have a portfolio of underlying stocks of the S&P 500, and they write calls on the same. They write about 25 to 75%. They do the index calls, so they write on the whole index itself, and they hold the components or the stocks of the index. So that's a great pick. Like I like GPIX because they do the dynamic writing. They don't write calls at the same level every time. Like they don't do the systematic same type of calls. They do it in a very dynamic fashion, change according to the market conditions. The second fund, which is pretty good, is JP. Even though some performance metrics were not that good for JP in the charts that we observe, this has a similar design like underlying stocks of the S&P 500, and they rate calls on the S&P. So I don't have much information on the type of call writing they do, like whether it is systematic or dynamic. So JP's performance has been slightly lower compared to the GPIX. But you can look at JP if you're looking at funds which write options on the underlying stocks. So why I picked these two funds is because I am picking the funds that um, that are having a very high total returns, or they have to be funds which do the uh, you know calls on the underlying index or the stocks. So these are two other sorry ETFs to look at, and yeah, both of them have exposure to blue chip stocks. If you have any other picks or other better options, you know, any other newer funds that you are familiar with, please drop them in the comments below, and I look forward to hearing from you. I hope you like this video. If you have any comments, any other notes, or any feedback, please feel free to share them in the comment section below. I look forward to seeing you later. Thank you. Happy investing.